will my money last?
Right.
And the annuity concept of guaranteeing lifetime income is something that can help to fill that void. You can take a savings amount, a lump sum, and turn it into a lifetime of income with contractual guarantees.
Peter, good to see you. Welcome back, everyone. Today, a big question. Are annuities the right fit for your financial plan? Annuity sales set new records in 2024. In fact, the first 9 months of that year, we saw a 23% increase to $331.2 billion. LIMRA, which tracks the numbers, expects annuity sales to exceed $1.1 trillion from 2022 to 2024. So, Peter, clearly they're popular, but why do people have such a love-hate relationship with annuities?
Yeah, and not just 2024, going back those previous years, 2021 record sales, 2022 record sales, 2023 record sales. So there's been this stigma with annuities that I think the public is somewhat overcoming. Now, I say somewhat because there still is a stigma. Stigma sticks with us, and people were for a very long time very negative on annuities. And there are several big name pundits that echo that sentiment, that you should always forever stay away from annuities, never consider them. However, I think that they provide something that is very, very needed in today's retirement environment. And the annuities themselves have improved in a way that created a lot of the stigma previously. So the past generation of annuities operated much like a pension from a company. In fact, pensions from companies are annuities. But even with personal annuities, if I deposited my money and began taking a lifetime income, the money that I deposited in previous generations of annuities basically was vaporized. If I was hit by the proverbial bus 2 months later, that money went back to the insurance company, much like money in a company pension goes back to the company to pay employees who outlive life expectancies. Well, a lot of people had a lot of problems with that, rightfully so. Maybe mom or grandma invested in an annuity for lifetime income and then passed away shortly thereafter, and the money was gone. Well, what happened to mom's or grandma's money? Well, the insurance company kept it to meet the actuarial responsibilities that they had to other investors. Well, that is something that has changed a great deal over, I would say, the last 20 to 25 years. And I think it's taken the public a little while to catch on to this fact, but record numbers in sales are showing that they are catching on to the fact that you no longer are required to give up your underlying lump sum to create lifetime income from an annuity. And that is one of the big improvements with them. And the fact that they can provide a lifetime income like a pension, which so many people are missing as part of their support system in retirement, is why there is the surge in popularity and the record sales numbers. People need that lifetime income support. Social Security doesn't cover 100% of most people's lifestyle, almost nobody's. And even though this generation has done a fantastic job in building and accumulating wealth, they have more personal wealth in those 401ks and retirement accounts than any previous generation. There's more doubt and uncertainty of the question, will my money last? And the annuity concept of guaranteeing lifetime income is something that can help to fill that void. You can take a savings amount, a lump sum that you have to make last an uncertain amount of time, and hopefully longer than you need it to last. You can take that lump sum, and with an annuity, kind of the exclusive tool that can take a lump sum and turn it into a lifetime of income with contractual guarantees.
And of course, we've talked many times before about how retirees with a guaranteed income stream are happier. It makes sense.
And live longer.
Yes. So before we get into the different types of annuities, I do want to touch on one reason that annuities were seeing record sales. And that's because interest rates have been so very high, which makes annuities more attractive. Now, though, as you and I have talked about before, the Fed is lowering interest rates. So should we still be considering an annuity?
Yes, even before interest rates spiked, which certainly after we saw that record inflation and the Fed was raising interest rates, annuities did see a benefit from that. The interest rates, the indexing rates, the payout rates, the cash flow rates all saw a little bump up. But even before that, if you took a portfolio with the traditional mix of stocks and bonds, and you took out some of the bonds or even all of the bonds and replaced it with a fixed or a fixed indexed annuity, you did three things essentially. You lowered the risk of the overall portfolio, you increased the yield or the cash flow rate, and oftentimes you lowered the fees or expenses on the overall portfolio. And that was before the spike in interest rates. And by the way, just because the Fed has lowered interest rates a few times and announced that they will continue to do so, that has not necessarily reflected across annuities totally, not across the industry. There are still places where you can get higher than what we have seen average indexing rates, higher than prevailing bank or money market rates on savings accounts or even CDs, and higher cash flow rates than what a lot of bond yields or stock dividends are paying. And again, with certain contractual guarantees, so not risking that into the future.
Mm-hmm. So now I think is a good time then, Peter, to talk through the different kinds of annuities.
Yeah. And when I say not risking, there are different types of
Yes.
annuities.
Right.
And unfortunately, I am seeing annuities missold, misrepresented. That's another key issue I probably needed to hit on with why are people apprehensive or why there's such a division on annuities. When an annuity is missold or misplaced, or especially when I am unfortunately seeing them a lot of times misrepresented. People have expectations that they are going to have wild market linked growth that gets the entire growth of the market, when in actuality, typically they don't. But annuities have different iterations and variations to the build, the chassis. And so when I talk about contractual guarantees, I want to specify that variable annuities are akin to, they are similar to mutual funds in the market. They can go up, they can go down. If the market goes down, you can and will lose value to your accumulation value or your contract value. There is risk with variable annuities. And so generally, I don't see as much value or use from a variable annuity, because if we wanted the risk of the market, we should just invest in the market where we can eliminate some underlying fees and expenses that variable annuities often have higher fees and expenses. But if we are looking for contractual guarantees, for some safety, for removing risk from a portfolio, then we are looking at fixed or indexed annuities. And a fixed annuity is similar in the way that it operates to a CD. It's got a fixed interest rate for a set amount of time. And at the end of that period of time, you take your original principal plus the interest that you gained, and you walk away and you make some kind of different decision with your money. It is a lump sum liquidity event at the end of the term. And those can range from 2 years to 3 to 5 to 7 to 10. And there's a duality there for locking in your money. And this is one of the downsides of annuities, is that you're trading something when you're getting the safety and growth. You're trading liquidity, right? So people didn't really always like that lack of liquidity and the time commitment. But when we are talking about the Fed is lowering interest rates, and we expect interest rates for the next several years to be lower than they are today, right, there's two sides to locking in your money, is that you're also locking in these currently higher interest rates for a longer period of time. So the fixed rate annuities do have that as an attractive feature. And again, at the end of the term, you walk away and you make some kind of different decision with your money. The indexed annuities I think are the ones that I'm unfortunately seeing missold a lot, because they are being portrayed as though they're going to get all of the returns of the market, like a mutual fund or a ticker on an ETF or a variable annuity, but have none of the risk of the market like a fixed. The truth is that you give up something where you gain something. There's pros and cons to everything, and you've got to understand that these are savings accounts. You're not going to get the full gains of the market, but you have eliminated the downside risk with an indexed or a fixed indexed or a hybrid annuity. They go by different names, but with a indexed annuity, you have no risk of market losses, and you get to share in the gains of the market on the upside. Now, they've got all kinds of convoluted equations and different indexing options that I think, again, people are very confused by, because they often get misrepresented and talked about like an advisor is managing these on a day-to-day basis and therefore can have some secret to capturing more of the gains of the market. Generally, they are tied to fixed income kind of conservative underlying assets or indexes, sometimes to the S&P or other more equity-based indexes, but have a limit on the amount that you can gain when the market goes up. Where you are giving up the downside risk, you are also going to not capture 100% of the gains of the market. And that, I think, is leading to some false expectations, specifically with indexed annuities. Erin, where I really utilize them, though, is for the guaranteed lifetime income benefit.
Right.
And that is an additional component, generally a rider that comes as an attachment onto these vehicles that sometimes has an extra cost, but it does guarantee the lifetime income producing ability of the lump sum that you've deposited, plus some amount of growth between now and when you want to start that income. So good for like a 55 or a 60-year-old who's thinking of retiring maybe at 65 or somewhere down the road, or even if you are looking to create income sooner, like within the first year of deposit. Sometimes these can be advantageous.
I've been hearing a lot about registered index-linked annuities lately. In fact, sales of RILAs, as they're known, are up 37% from the previous year. So how is that different, and who should be considering a RILA annuity?
So again, there's a lot of different names and components and builds to the chassis, right? Like they're all vehicles, but they have different nuts and bolts for how they're put together. If you think of, an automobile, there's trucks, there's cars, there's sedans, there's sports cars, there's convertibles. There's all kinds of different vehicles, and it's very important to know what kind of annuity you're getting in. These registered indexed linked annuities are kind of a hybrid, even more minutia middle ground between the variable and the indexed. And what they do is they give you kind of a range of expected outcome that you can only make up to X or only lose down to Y. They don't give you 100% bottom line safety guarantees, but they give you a range where these things are going to finish. I would rather go with identifying the money that is intended for risk for growth and leave that in the market and equities, and identifying the money that we want to have safety with and don't want to lose, and then consider maybe a fixed or an indexed annuity with that, rather than this kind of convoluted hybrid between them. I do understand the appeal. I think there are other vehicles that can do the same thing without some of the internal cost and without the long-term time commitment clunkiness. If you go 3 or 5 years and then want to pivot and change your mind, some other better opportunity comes up, or you realize you have different needs with your money, that you can go a different direction. I would rather time optimize the portfolio, like what we've talked about many times in building a retirement income plan, Erin. Identify what's 10 years or longer kind of money and have that in the market for growth. An annuity should never be a place for all of your money, but it can be the place for money that you want for lifetime income, or the money that is like 3 to 5 years to 10 years. Much beyond 10 years, I think there's other better places for long-term growth. If you need your money within a shorter term, an annuity is also probably not the right place for it.
And one more question, because I know you're always thinking about taxes, but it comes up again and again. How are annuities taxed?
So annuities can provide some tax benefits in certain circumstances with non-qualified money, meaning this is not retirement money. It's not an IRA, it's not a Roth. You're going to get really no additional tax advantage if you've got an IRA or a Roth, because those are bubbles that are around your money that provide certain kinds of protection. And an annuity is just one choice that you can put inside of that bubble. But when you pop the bubble and pull the money out, it's going to have the tax implications associated with the bubble itself, not with the financial vehicle. So whether it's stocks, bonds, mutual funds, ETFs, or annuities, or whatever inside of an IRA bubble, when you pop the bubble, pull the money out, it's going to be taxed as brand new income. If it's a Roth bubble, then you've already paid your tax before you put the money in. And when you pop the bubble and pull the money out, it's tax-free to you. That's the benefit of a Roth. So with non-retirement money, if you were to put that in a bank account or a CD, the interest that grew each year would be taxable again. And then when you pulled the money out, you would have already paid tax along the way on all of that interest-based growth. With an annuity, you defer the taxes while you are growing and deferring. So each year you don't get taxed on the growth. But at the end, when you pull the money out, you have a couple choices. You could put that into another annuity and continue tax deferral. But if you remove it, if you take it out and do something else with the money, then at that point in time, the growth has not been taxed and it will be taxable. It'll be taxable at that point as though it's brand new income. So it's taxable like income tax. And in comparison to a bank account, that may be a slight advantage to get the compounding of the tax deferral on the growth, compared to maybe stocks or ETFs, where you have the potential for holding an investment for a long-term period of time. If you've got long-term capital gains compared to being taxed as income, that may be a potential disadvantage. So you've really got to carefully weigh the kind of money, the purpose, the timeline, and the type of risk exposure that you would choose if you had an alternate investment, right? This is choice A. Well, what would happen if we instead chose choice B? How do the taxes of those two things compare? And you've got to kind of compare and contrast and weigh the benefits and disadvantages of each, because that is a little complex. But generally speaking, if it's IRA money or Roth money, there is no difference from any other investment. If it's just after-tax, non-qualified investment, then it is taxed as income when withdrawals are taken, and you carefully need to weigh how that would compare to other alternatives you would consider.
Clearly, no cookie cutter answer and so many different options. So it warrants a conversation with a professional. So, Peter, if somebody wants to have that conversation with you, how can they get a hold of you?
Yeah, give me a call. I would love to talk it over, whether you're considering an annuity, whether you've sort of been told you should purchase one, whether you already own one and just want to get clarity on what you own, because I see a lot of people really confused about them. Give me a call, please. I'd be happy to talk with you. Make sure you understand what you own. That's a big goal for me, for every investor, to be more informed about your money. 919-300-5886, 919-300-5886. And annuities are complicated enough on their own without them being misrepresented. And I'm having a real problem with this recently, seeing people who just, when they tell me what they were told when they were making a purchasing decision, it just doesn't line up with what they actually own. So I'm having a real problem with that. And hopefully, anybody with an annuity or considering an annuity, it's not that they're always good. It's not that they're always bad. You just need to understand them. And they're pretty much never the right place for all of your money. Mutual funds are complicated too, Erin. But if you want to get out of a mutual fund, you sell it and you're out that day. That's not complicated. Whereas annuities, sometimes they're simpler than mutual funds, but if you want to get out of them, if you're in one and didn't understand it, that part can be complicated. And so it's really important that people understand what's going on with their money, what kind of vehicle they're in, and the ins, the outs, the nuts and bolts of their annuity.
All right, Peter, thanks so much for your time today. I appreciate it.
Always a pleasure, Erin. Thank you. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. You know, one of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Index or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract. Guarantees are backed by the financial strength and claims-paying ability of the insurer. Please refer to our firm brochure, the ADV2A Item 4, for additional information.